Disclaimer.
$36 trillion. That's America's national debt sitting on the books right now, today, not some future projection, but the actual bill we're carrying as of January 2026. And if you think that massive number is just an abstract government problem that doesn't touch your wallet, your retirement account, or your family's financial future, I need you to pay very close attention to what I'm about to show you. Because while you were checking Instagram and planning your next vacation, the world's largest money manager just executed the biggest portfolio shift in modern financial history. BlackRock quietly repositioned over $2.1 trillion away from traditional U.S. investments, the very assets they have been telling everyday Americans to buy and hold for decades. We're not talking about minor adjustments or routine rebalancing. This is a fundamental reassessment of American financial stability happening in real time, and most people have no idea it's even occurring. Let me walk you through exactly what I discovered in Treasury Department data and BlackRock's institutional filings, and why this massive repositioning in January 2026 represents the most significant vote of no confidence in U.S. assets since the 1970s. This isn't financial theory. This is trillions of dollars moving right now. BlackRock manages over $10 trillion in assets. That's roughly half of America's entire GDP, more than the combined economies of Germany, France, and the UK. When they move money, they're not making bets. They're reading signals the rest of us don't see yet. And right now, according to their December 2025 outlook released to institutional clients, they're warning about something they call a fragile financial equilibrium in U.S. markets. Here's where it gets interesting. While publishing those cautious words about American financial stability, BlackRock was simultaneously executing the largest Bitcoin accumulation in financial history. In just the first week of January 2026, their Bitcoin ETF pulled in over $1 billion in new investor money. Not over a quarter, not over a month, one single week. Their total position now sits at 774,000 Bitcoin, worth approximately $70 billion at current prices, making BlackRock the largest institutional holder of Bitcoin on planet Earth. Think about that for a moment. The same firm managing your parents' 401k and your pension fund is now the world's biggest holder of what they once called rat poison squared. But here's what should really grab your attention. This isn't just about Bitcoin. According to Treasury International Capital data released by the U.S. Department of Treasury in December 2025, BlackRock has been systematically reducing their exposure to U.S. Treasury bonds across their entire portfolio. We're talking about the investments that financial textbooks have called risk-free for over a century, the foundation of every conservative investment strategy in America. They're not alone in this repositioning. The data tells a story that our financial media seems remarkably uninterested in covering. China's holdings of U.S. Treasury securities dropped to $688.7 billion in October 2025, according to official Treasury data. That's the lowest level since November 2008, right in the middle of the financial crisis. Even more striking, this represents a 47% decline from their peak holdings of $1.32 trillion. China has cut their stake in American debt by nearly half, and they've been doing it gradually enough that most Americans never noticed. Japan, our closest ally and historically our largest foreign creditor, sold off $227 billion in long-dated Treasury securities throughout 2025 alone. These are 30-year bonds, the kind that lock in relationships between nations for a generation. Japan is telling us something through their actions, even as their politicians speak diplomatically about our alliance. The numbers get more concerning when you zoom out. Foreign official institutions, that's central banks and sovereign wealth funds around the world, recorded net outflows of $19.2 billion from U.S. Treasuries in October 2025 alone, according to the most recent Treasury International Capital report. These are the steady conservative investors who traditionally bought our debt regardless of market conditions. They're walking away. Now, you might be thinking, markets go up and down, investors shift allocations all the time. What makes this different? JP Morgan's quantitative research team answered that question in their year-end analysis. They identified what they call the Sell America signal, a simultaneous occurrence of three conditions: falling U.S. stock prices, a weakening dollar, and rising Treasury yields. You'd think at least one of these would move in our favor, right? When stocks fall, money usually floods into Treasuries for safety, pushing yields down. When the dollar weakens, foreign investors typically buy more of our debt because it's cheaper for them. But that's not happening. All three are moving against us simultaneously. According to JP Morgan's historical analysis going back to 1970, this trifecta has only occurred 13 times in over 50 years. The last time? 1981. That was the year we hit peak interest rates under Volcker, inflation was still raging in double digits, and America was questioning whether we'd lost our economic dominance to Japan and Germany. For 43 years since then, the pattern stayed broken. U.S. assets moved in the predictable correlations we built our entire investment industry around. Stocks down, Treasuries up, dollar weak, foreign buying increases. This reliability was not just convenient, it was the foundation of the safe haven status that let our government borrow at lower rates than any other nation on earth. That 43-year pattern just shattered in 2025, and we're living through the aftermath right now in January 2026. Let me put this in perspective with a scenario you can relate to. Imagine you're planning a vacation to Europe. You check the exchange rate for US dollars to euros, and it's worse than last month. Normally, that would make your trip more expensive, but you would also notice that your Treasury bond holdings increased in value as foreign investors bought more American debt. The system balanced itself. Now imagine that same scenario, except when you check your brokerage account, your Treasury bonds have actually lost value because yields spiked, and your stock portfolio is down too. And the dollar is still weakening. All your traditional safe investments are moving in the wrong direction at the same time. That's not a vacation planning problem anymore. That's a signal that the fundamental rules of how global capital flows work might be changing. The people moving billions of dollars every day have clearly received this signal. BlackRock, its pivot toward Bitcoin and away from long-dated treasuries, is not a speculative gamble. It's portfolio insurance against a scenario their own research division is explicitly warning institutional clients about. What scenario? The breakdown of the post-1981 financial order, where U.S. assets automatically attracted global capital regardless of our fiscal situation. For 4 decades, we could run deficits, print money, and expand debt because the world kept buying our treasury bonds and propping up our currency. That implicit agreement, what economists call dollar hegemony, appears to be fracturing in real time. The fracture isn't happening through dramatic announcements or emergency G7 meetings. It's happening through the quiet, methodical repositioning of trillions of dollars by the people who manage money for a living. They're not waiting for permission or confirmation from financial media. They're reading the same Treasury data you can access right now, running the same historical comparisons, and reaching the same uncomfortable conclusion. The world's smart money is diversifying away from America, and they started moving months before most Americans even knew to ask why. This raises an obvious question. If the financial system really is this fragile, and if these moves are this significant, why isn't this the top story on every news channel? Why aren't we having national conversations about what it means when China and Japan and BlackRock all simultaneously reduce their faith in U.S. assets? The answer lies in understanding how modern fiscal crises unfold, not through sudden crashes, but through gradual losses of confidence that don't make good television until it's too late. The Roman Empire didn't collapse in a day. It debased its currency over decades, while citizens slowly realized their savings were losing purchasing power. Which brings us to the question every American should be asking right now. If we're in the early stages of a similar debasement, what's driving it, and how much time do we have to prepare? The answer to that question starts with understanding a term that just entered mainstream financial discussion this month: fiscal dominance. Treasury Secretary Janet Yellen used these exact words in a warning to Congress in January 2026, and once you understand what she's really saying, BlackRock's $2.1 trillion repositioning suddenly makes perfect sense. But to grasp what fiscal dominance actually means for your savings, we need to go back nearly 2,000 years to Rome in 200 AD. Because what's happening to the American dollar right now is the exact same mechanism that destroyed the Roman denarius, just using modern financial tools instead of silver coins. The Roman Empire in 200 AD looked invincible from the outside. Roads connected 3 continents, legions protected borders stretching from Britain to Mesopotamia. Trade flowed freely across the Mediterranean. Roman citizens enjoyed a standard of living that wouldn't be matched again for over 1,000 years. But beneath that prosperity, the empire faced a problem that sounds painfully familiar to anyone paying attention to American finances today. Military spending was consuming more tax revenue than Rome could collect from its provinces. The cost of maintaining legions on distant frontiers, building infrastructure across an enormous territory, and providing benefits to citizens and veterans had created obligations the imperial treasury simply couldn't meet through taxation alone. Emperor Septimius Severus, who ruled from 193 to 201 AD, came up with what seemed like an elegant solution. Roman coins were made from silver, and their value came from the actual precious metal content inside each coin. Severus ordered the imperial mint to reduce the silver content in the denarius from 90% pure silver down to about 50%, but keep stamping the same face value on each coin. One denarius still said 1 denarius on the face, but it now contained half the valuable metal it used to hold. Think about what this meant for an ordinary Roman soldier who'd spent 20 years in the legions, carefully saving denarii for his retirement. He had a chest full of coins that looked identical to the ones he had been paid when he first enlisted. The number stamped on them hadn't changed, but the purchasing power of those savings had been cut in half through government policy, and most soldiers had no idea it was even happening until they tried to buy land and discovered prices had doubled. The soldier didn't lose his retirement money through theft or bad investments or gambling. His government simply debased the currency to pay its bills, and a lifetime of disciplined savings evaporated without him understanding the mechanism that destroyed his wealth. Now here's where this becomes directly relevant to your 401k, your Treasury bonds, and every dollar sitting in your bank account right now. Janet Yellen's January 2026 warning about fiscal dominance is describing the exact same mechanism Romans used, just executed through monetary policy instead of reducing silver content in coins. According to data from the Treasury Department and Congressional Budget Office, the United States has crossed 120% debt to GDP ratio. Let me put that in terms you can visualize. For every single dollar that our entire economy produces in a year, every car sold, every software subscription purchased, every medical procedure performed, every bushel of wheat grown, our federal government owes 1.20 in debt that must eventually be repaid with interest. We're not talking about mortgages held by homeowners or corporate debt from businesses. This is purely what the federal government has borrowed and must repay using tax revenue it collects from us. That interest payment alone now costs us over $1 trillion annually. $1 trillion just to service the debt we've already accumulated before we spend a single penny on defense, Social Security, Medicare, education, infrastructure, or anything else Americans expect from their government. To understand the scale, all the individual income taxes collected across America barely cover our defense spending and interest payments combined. Everything else, every government program, every federal employee's salary, every Medicare claim, runs on borrowed money we're adding to an already unsustainable debt pile. This is where fiscal dominance becomes the modern equivalent of Roman coin debasement, and why Yellen's warning should alarm anyone with savings in dollars. Fiscal dominance means our government's debt has grown so large that the Federal Reserve can no longer set interest rates based on what's healthy for the economy. Instead, the Fed must keep rates artificially low to prevent the government from defaulting on its debt obligations. If interest rates rise to where they should be based on inflation and economic conditions, the interest payments on our $36 trillion debt become mathematically impossible to pay, and the entire financial system collapses. Sound familiar? This is exactly what Roman emperors did. They couldn't raise enough tax revenue to cover their military and social obligations, so they debased the currency to make their existing debts easier to pay off with cheaper money. We can't raise enough tax revenue to cover our obligations, so we keep interest rates artificially suppressed and print money to bridge the gap. The mechanism is identical. We've just replaced physical coin debasement with monetary policy manipulation. The mathematics here are absolutely ruthless, and they don't care about political party, economic theory, or anyone's good intentions. According to official Treasury Department data, U.S. debt increased by $2.23 trillion in just 1 year, from December 2024 to December 2025. That works out to an average of $6.12 billion added to our national debt every single day, including weekends and federal holidays. Now, here's the part that should really grab your attention. This $2.23 trillion debt increase happened during a period of supposed economic strength. Unemployment was relatively low. The stock market hit multiple record highs. GDP was growing at a respectable pace by historical standards. These were supposed to be the good years when we pay down debt, not explode it further. If we're adding $6 billion to the national debt every single day during the good times, what happens when we hit the next recession? What happens when unemployment spikes and tax revenues collapse? What happens when the next financial crisis requires trillion-dollar bailouts? The addiction isn't cyclical, it's structural. When we've built a government that literally cannot function without adding trillions to the debt pile, regardless of economic conditions. The Congressional Budget Office, which is required by law to use optimistic assumptions in their projections, estimates that even under rosy scenarios, assuming no major wars, no financial crises, no pandemics, no unexpected emergencies, our national debt will reach 134% of GDP by 2035. That's assuming everything goes right for the next decade, which anyone who lived through 2008 or 2020 knows is wildly unrealistic. BlackRock sees these exact same numbers in their analysis, and their December 2025 outlook to institutional clients included a statement that was remarkably blunt by Wall Street standards. They explicitly warned that highly indebted governments create a more levered financial system vulnerable to shocks like bond yield spikes. Let me translate that corporate speak into plain English for you. What BlackRock is telling their biggest clients, pension funds, sovereign wealth funds, billionaire family offices, is that when governments owe this much money relative to their economy, the entire financial system becomes fragile. Any sudden increase in interest rates, any loss of confidence that causes bond yields to spike upward, could trigger a cascade of failures that brings down banks, pension funds, insurance companies, and potentially the currency itself. Think about what that means for your retirement account. Most Americans have a significant portion of their 401k allocated to U.S. Treasury bonds because financial advisors have been calling them risk-free assets for generations. These bonds have been the foundation of conservative investment strategies, the safe harbor you're supposed to move money into as you approach retirement age. But BlackRock, while still managing trillions in these same Treasury bonds for everyday clients, is simultaneously telling their institutional investors that these supposedly risk-free bonds are actually sitting in the blast zone of a potential fiscal crisis. And more importantly, BlackRock is backing up those private warnings with concrete action, systematically reducing their own Treasury exposure and moving billions into alternatives like Bitcoin, private equity, and hard assets. This is the Wall Street equivalent of a fire chief, telling the public that everything's under control while quietly moving his own family out of the building. Their actions speak infinitely louder than their carefully crafted public statements. You know what's fascinating and terrifying about the Roman currency debasement. It didn't happen all at once. Septimius Severus reduced silver content from 90% to 50%. Then his son Caracalla reduced it further to 40%. Then subsequent emperors kept going, 60% debasement, 70%, 80%. By 270 AD, barely 70 years after Severus started the process, Roman coins contained less than 5% actual silver. Each emperor kicked the problem down the road, made it somebody else's responsibility, until the debasement crossed a point of no return and the entire monetary system collapsed within a single generation. The debasement was gradual enough that most ordinary Roman citizens didn't fully understand what was happening until it was too late. They kept accepting the coins at face value, kept saving them for the future, kept trusting that their government would maintain the currency's purchasing power. By the time they realized their savings had become nearly worthless, decades of accumulated wealth had evaporated. We're watching the same slow-motion debasement unfold right now, just measured in interest rate suppression and money printing instead of silver content reduction. The Federal Reserve keeps interest rates artificially low, despite obvious inflation concerns, because raising them to economically appropriate levels would make our debt service payments literally impossible to sustain. Every year we add multiple trillions more to the debt pile, making next year's problem exponentially worse, pushing the inevitable reckoning further down the road while making it more catastrophic when it finally arrives. Janet Yellen's January 2026 warning about fiscal dominance is historically significant because it represents the moment when even government officials started admitting publicly what the raw numbers have been screaming for years. When mainstream financial publications like Fortune and Bloomberg, along with Treasury officials themselves, all start using the term fiscal dominance. In the same month, it tells you the situation has progressed beyond the point where it can be quietly managed behind closed doors through technical adjustments. The insiders are now speaking openly about the crisis because they know informed people can already see it in the data. The secret is out. And that brings us full circle to BlackRock's $2.1 trillion repositioning away from traditional U.S. investments. This is not a speculative bet on Bitcoin prices going up or a tactical trade based on short-term interest rate movements. This is institutional portfolio insurance, moving client capital away from assets that will be destroyed if fiscal dominance leads to the same outcome it's led to throughout history. Currency debasement that wipes out the purchasing power of anyone holding bonds and cash. BlackRock is reading the same historical playbook that shows what happens when empires cross into fiscal dominance territory. They're seeing the same debt numbers, the same impossible interest payment trajectories, the same political paralysis that prevents any real solutions. And they're systematically moving trillions of dollars out of harm's way before the general public even understands there's a fire alarm ringing. The Roman soldiers who diligently saved their debased denarii for decades didn't understand monetary economics. They trusted their government, believed in the strength of the empire, followed the conventional wisdom of their time, and kept accumulating coins right up until those coins became essentially worthless for purchasing real goods and property. History remembers them as victims of circumstance, good people who played by the rules and lost everything through mechanisms they couldn't see coming. They didn't have access to Treasury data or historical analysis or warning signals from the Roman equivalent of BlackRock. But you do. The question facing every American right now is straightforward. Are you going to study what's happening and take action to protect your wealth? Or are you going to be the 21st century equivalent of those Roman soldiers, blindly trusting that somehow this time will be different? So here's the question everyone asks at this point. If this crisis is really building, how much time do we have? When does the slow-motion repositioning we're seeing from BlackRock and foreign central banks accelerate into something that affects ordinary Americans in their daily lives? The data suggests we're looking at a window somewhere between 18 months and 3 years before the system reaches a breaking point. And I can show you exactly why that timeline is becoming increasingly credible based on the acceleration we're witnessing right now in early 2026. Let's start with the most measurable indicator, the pace of foreign treasury selling. From 2013 through 2024, foreign institutions reduced their Treasury holdings gradually, almost politely. We're talking about modest quarterly declines that could easily be explained by normal portfolio rebalancing or currency management. Nothing that screamed crisis. Then 2025 hit, and the selling pattern fundamentally changed. It went from gradual to aggressive. China alone dumped holdings at a pace we haven't seen since the 2008 financial crisis. Japan, which had been the most reliable buyer of U.S. debt for decades, sold $227 billion in long-dated treasuries in a single year. These aren't normal portfolio adjustments. This is strategic repositioning happening on an accelerated timeline. But here's where it gets really interesting. On January 5th, 2026, just a few days ago, Bitcoin ETFs recorded inflows of $697 million in a single trading day. That's the largest daily inflow since October 2025, and it happened in the first full trading week of the new year. Institutional money isn't waiting around anymore. They're moving capital into alternative stores of value at a pace that suggests they see something coming in the near term, not the distant future. And then there's the language shift that should grab everyone's attention. The term fiscal dominance entered mainstream economic discussion in January 2026 through Fortune, Bloomberg, and statements from Treasury officials themselves. When establishment media and government sources start openly discussing a concept that was confined to academic economics papers just 6 months ago, it tells you the crisis has progressed beyond the point where it can be quietly managed through back-channel communications. Here's a pattern you need to understand about financial crises. By the time mainstream media acknowledges the problem, institutional money is already repositioned. The insiders don't wait for CNBC to tell them what's happening. They read the same data we're looking at now, and they move months ahead of public awareness. So if fiscal dominance is being discussed openly in January 2026, when did BlackRock and other major institutions start repositioning their portfolios? Probably mid to late 2025, which is exactly what the Treasury International Capital data confirms when you dig into the details. Now let's talk about specific dates and catalysts that could accelerate this crisis from slow burn to acute emergency. The Social Security Trust Fund hits technical insolvency in 2032. That's just 6 years away. When that happens, benefits automatically get cut by 24% unless Congress passes legislation to prevent it. Think about what that means. Every retiree counting on Social Security would see their monthly check drop by nearly a quarter. The political and economic shockwaves from that alone could trigger the kind of confidence crisis that turns gradual Treasury selling into a stampede for the exits. But we don't even need to wait until 2032 for fiscal stress to intensify. The one big beautiful bill that Congress is currently debating adds $4.1 trillion to the national debt through 2034, with approximately $500 billion being added in 2026 alone. That means that in addition to the $6 billion, we are already adding to the debt every day through normal operations. We're about to accelerate the borrowing substantially. More borrowing means more Treasury bonds flooding the market. More bonds means either interest rates have to rise to attract buyers, or the Federal Reserve has to print money to buy the bonds themselves. Either option is catastrophic for different reasons. Higher rates make the debt unsustainable and trigger defaults. Money printing destroys the dollar's purchasing power and sparks inflation. Bond market stress indicators are already flashing warning signals. Treasury yields have been spiking despite the Federal Reserve maintaining a dovish stance and signaling they want to keep rates relatively low. When yields rise even as the Fed tries to suppress them, it means the market is losing confidence in its ability to control the situation. That's the early warning system telling you that we're approaching what economists call the confidence break. Based on historical analysis of other reserve currency transitions, the British pound losing its status after World War II, the Dutch guilder's decline in the 1700s, the confidence break typically occurs when several factors align simultaneously: accelerating fiscal deficits, foreign creditor exodus, and a viable alternative emerging that allows global trade to function without the failing currency. We can check all three boxes right now in early 2026. Our deficits are accelerating despite economic growth. Foreign creditors are actively reducing exposure. And Bitcoin, combined with increased bilateral trade settlements in local currencies between major economies, is creating alternatives to dollar dominance. If these patterns continue at their current pace, the confidence break could occur somewhere between Q3 2026 and Q1 2027. That's 9 to 15 months from now, not next decade, not some distant future problem, this year or early next year. So what do you actually do with this information? How does an ordinary American with a 401k, a mortgage, and kids to put through college prepare for this kind of systemic shift without becoming a paranoid survivalist living in a bunker? Let me give you a rational, historically grounded survival protocol that wealthy families and institutions are already implementing. This is not doomsday prepping. This is portfolio insurance based on what assets actually performed well during the last time America faced similar fiscal stress in the 1970s. First, diversify 20 to 30% of your liquid wealth into assets that maintained or increased purchasing power during the 1970s stagflation period. Gold rose 1,400% from 1971 to 1980. The Swiss franc appreciated 300% against the dollar during the same period. Commodity indices rose approximately 200%. These aren't speculative recommendations. This is historical data showing what preserved wealth when dollar confidence eroded last time. You don't need to bet your entire net worth on gold or Bitcoin, but having zero exposure to hard assets when the world's largest money manager is moving billions into exactly these positions seems like willful blindness at this point. 20% is enough to protect you if the dollar weakens substantially, without leaving you completely exposed if the crisis takes longer to materialize than expected. Second, maintain 6 to 12 months of living expenses in physical cash or stable foreign currencies, not in a checking account that's just digits on a bank's computer. Actual physical currency you can access immediately if electronic payment systems experience disruptions. During the 2008 financial crisis, there were brief periods where ATMs ran out of cash and credit card networks struggled with transaction volume. Having physical currency means you can buy groceries, gas, and essentials regardless of what's happening with the banking system. Third, reduce or eliminate any variable rate debt before Q3 2026. If you have credit cards, home equity lines of credit, or any other debt where the interest rate can increase, pay them down or lock in fixed rates immediately. When fiscal dominance breaks down and the Fed loses control, interest rates can spike suddenly and dramatically. Variable rate debt that's affordable at 7% becomes devastating at 15%. Ask anyone who lived through the early 1980s when mortgage rates hit 18%. Fourth, consider geographic diversification if you have substantial assets. This doesn't mean you need to move to another country, but having a bank account in a jurisdiction with strong fiscal fundamentals provides optionality. Look for countries with debt to GDP ratios below 60%, places like Singapore, Norway, or Switzerland. If the dollar experiences a serious devaluation or banking stress, having some portion of your wealth in a more stable currency and banking system gives you alternatives. Now I know what some of you are thinking. This sounds extreme. This sounds like the kind of advice people laughed at in 2006, right before the housing market collapsed and took the financial system down with it. Here's the thing. BlackRock is doing every single one of these things right now with their institutional clients' money. They're not waiting for permission or consensus or for the mainstream media to validate the strategy. They're reading the Treasury data, seeing the same historical patterns, and repositioning trillions of dollars accordingly. The difference between you and BlackRock is simply information and timing. They have teams of analysts studying this full-time, and they started moving months ago. You're getting this information now in January 2026, which still gives you time to act before the situation escalates. This isn't about panic. This isn't about fear. This is about rational risk management based on measurable data and historical precedent. When someone shows you that your house is slowly filling with smoke, the reasonable response isn't to panic and jump out a window. It's to calmly locate the fire, call for help, and move toward the exits while you still have time. The fire in this case is $36 trillion in debt growing by $6 billion per day. The smoke is foreign creditors quietly selling treasuries and BlackRock repositioning $2.1 trillion away from U.S. assets. The exit is diversifying into assets that historically preserve purchasing power when currencies weaken. You still have time to walk toward that exit calmly and deliberately. But the window is measured in months now, not years. The acceleration we're seeing in early 2026, the aggressive Treasury selling, the massive Bitcoin inflows, the mainstream acknowledgement of fiscal dominance, all of this suggests that whatever is coming is closer than most Americans realize. The Roman soldiers who saved debased denarii for their retirement didn't have access to government data showing the silver content in their coins was dropping. They didn't have historical examples to study. They didn't have warning signals from major financial institutions. You have all of those things right now. The data is public. The historical playbook is clear. The warning signals from BlackRock couldn't be more obvious if they took out billboards saying, "We're moving $2.1 trillion because we see a crisis coming." The only question left is what you're going to do with this information. Are you going to take rational, measured steps to protect your family's financial future? Or are you going to trust that somehow, despite all the data and all the history, this time will be different? Because I can tell you with absolute certainty, it won't be different. Fiscal dominance always ends the same way throughout history. The only variable is whether you positioned yourself to weather the storm before it arrived, or whether you're trying to find shelter after the hurricane has already made landfall. The choice, as always, is yours. But choose soon, because that 18-month window is already ticking.